Hey guys, welcome to my video on economic growth. In this video, I'm going to dig a little deeper into economic growth and specifically into some cross-country comparisons and some trends over time. Because for most of the world's history, there wasn't any economic growth. From like a million BC up to like the year 1300, growth rates were basically zero. People barely had enough food to live on, and that's about all they had. Then we had some teeny growth, like the global growth rate was like 0.2% for a few hundred years, all the way up until 1750. Sometime in the 1750s, the Industrial Revolution kicked off. Now, what was that? That was some inventor in England who created a machine that could create cotton products like clothing and stuff, and it was steam powered. It was the first time where it could have a lot of capital doing the production instead of the labor. And that triggered a whole bunch of other innovations. And it brought on so much change that we call it the Industrial Revolution. And since that time, the world has seen sustained economic growth. And it's the only time in history where we've had that. Now, why did it happen in England and why in 1750s? We don't know exactly. We do think, as economists, the royal we do think it has something to do with property rights. And there were some different political changes going on then where the environment was just good for someone to have a new idea, to make an invention, to innovate, and to benefit from it. And property rights will be one of our big themes when we talk about growth. It's a necessary condition. People have to have an incentive to want to do things better. Now, growth rates matter. And if you remember our rule of 70, small changes in a growth rate can make a big difference, especially if you're going to talk about them over the long run. For instance, if you have a 2% growth rate, then every 35 years approximately, your average income in your economy will double. But if you only have a 1% growth rate, it'll take 70 years for your average income to approximately double. So let's talk about some cross-country comparisons. Like, where are we at today? There are a lot of high-income countries, also called industrial countries, also called developed countries. You know, we have the United States, Australia, Canada, Japan, New Zealand, pretty much everything in Western Europe. There's a lot of big, rich countries that have experienced a lot of growth over the last little while. And there are a lot of lower income countries or developing countries, which most of the countries in Africa, Asia, Latin America qualify for that in one way or another. And it seems like the rich get richer, but some countries catch up and others just get left behind. So what's going on? We can put a little bit of context on it before we do. Just because someone's getting left behind in their growth rate does not mean that their standard of living is unchanged. For instance, a lot of technology changes and knowledge advancements benefit poor countries and rich countries alike. If we develop a cheap vaccine that can prevent the spread of deadly diseases, or even just annoying diseases, I suppose, but cheap medicine can benefit a poor country and a rich country, even if it was developed in a rich country. So as our knowledge spreads throughout the world, that benefits people even in poor places. So I don't want to pretend that growth is everything, but it is important. So what determines how fast a country grows? Well, we need a model to describe this. So I'm going to start by talking about a solo growth model, which started to be developed by Robert Solow in the 1950s. He won the Nobel Prize later because of it, and a lot of other stuff he did. And what it does is it links capital per worker to GDP per worker. And I'll go into the technical details on the video that you'll see in the end screen here, okay? You can get to it, but you'll see that there's capital per worker, K over L, on the x-axis, and there's GDP per worker, Y over L, on the y-axis, and it has diminishing marginal returns, meaning that it's steep at low levels of capital. So when you buy more capital per worker, it makes a big difference. And it gets flatter and flatter the more capital you get. This is important because it means that there's a limit to the benefits of adding capital per worker. Now, there's another factor that can promote economic growth, and that's technology change. And technology change can come from having the right amount of capital, having businesses innovate and develop new production methods, from having more education, from having more research and development, whatever. Lots of things can create better technology. And we've got capital per worker, and we have technology, and these two things promote growth. Don't forget, by the way, capital per worker can include both human capital and physical capital. Physical capital is the normal one that we usually think of, but human capital matters too. Smarter workers tend to be more productive, so if you make your workers smarter, you got some growth. So which is more important, capital per worker or technology change? Well, we could take a quick foray into looking at the Cold War between the United States and the USSR to see maybe, because the Soviet Union, they doubled down on the idea of getting more capital per worker, and they built tons of it. So many stinking factories and so much production. They really invested in this. It was a centrally controlled government, and they said, we're going to build a ton of capital. And they were very successful in doing that. But as they did, they experienced smaller and smaller returns on their investment. Literally, because there's diminishing marginal returns in the production function. What happened in the United States at the same time? With more market forces, there was more innovation and more independent thinking and more people like creating new things and doing better. So while the Soviet Union, their growth stalled, and eventually they kind of went bankrupt, in the US, we saw sustained growth. So you need both, like your workers need to have capital and you need technology. But as far as long run growth, our intuition is that technology change is the real enabler of long run growth. It's necessary because just throwing a bunch of capital in the economy can only get you so far because of diminishing returns. Now there's a new growth theory. So Solow was the 1950s. Paul Romer is still working hard. And he talked about new growth. And his idea has to do with knowledge capital being a determinant of economic growth. Knowledge capital is like the stock of knowledge we have in the economy. It can be within a business, it can be brought widespread throughout the country or the world, but it's about ideas. And knowledge capital, instead of having decreasing returns, he figures has increasing returns. Because when one person uses it, it doesn't mean someone else can't use it. We can all use it. One person creates some knowledge and everyone can increase their productivity from it. The more knowledge, the more everyone benefits. His theory also includes individuals and firms having economic incentives that affect the rate of technological change. That if there's more in it for us, we're more likely to engage in behavior that promotes technology growth. His model suggests some other problems. The knowledge capital idea, that everyone can share the knowledge, creates a bit of a free rider problem. I might be less likely to try to innovate if I know I can just mooch on whatever you innovate with. But there are some basic things we can do to avoid that. We can protect intellectual property with patents and copyrights, which make it so that once you create a new process or a new thing, you're the only legal seller for a while. The governments can also support research and development. They can also subsidize education. These things will all help promote technology growth, even with the free rider problem. Let's see, while I'm talking about Solow and Romer, let me throw one more guy in here real quick. Joseph Schumpeter, he was before Solow. His career really got going in the 30s. But he talked about a process called creative destruction, which is still something we're thinking about. When we have economic growth, when there's new technology and new things being created, it's often bad for some old industry. When the automobile grew in popularity, that was really bad for people who make horse and buggy carriages. When the cotton gin was created at the beginning of the Industrial Revolution, that was really bad for a lot of workers whose work is now being replaced. So economic growth is going to have some challenges for some. It's going to push some people around. Still really helps us in the long run. Now, we could talk about the US specifically because we had a lot of growth from the 1950s through the early 70s. Then we had slow growth from the mid 70s through the mid 90s, and then we've had more growth since then. But one thing we can say is that the growth since the 90s has a lot to do with information technology. Computers, software, cell phones, and all kinds of stuff like that have been promoting growth. There are some challenges to talking about this because, one, it's hard to measure some of the modern changes we've had. For instance, when I have the convenience of going to an ATM machine, whereas long ago I had to go to a bank during business hours, my convenience doesn't get measured in GDP. Or when I can just Google any question I want to, instead of having to go to a library to get a book on the issue, that convenience isn't measured in GDP. When I use social media, Facebook, Twitter, Snapchat, whatever, I get consumer surplus that isn't measured in GDP. A lot of our recent innovations don't really measure well in GDP. That does create some challenges. Now, since 2006, our growth has slowed substantially. There was a financial crisis, a big recession, and slow growth since then. Economists are divided on whether our growth is going to bounce back or not. There are some optimists who say we're going to go right back to the old productivity, which is great, which will mean massive improvements over decades. And there are some pessimists who say, yeah, we're in a long-run growth decline, and that's going to kind of stay that way. We don't know. We can debate about it, but it's going to matter one way or the other. Now, let's step back from the US. Let's talk about the rest of the world. Why isn't the whole world rich? Right? We've got growth. We get capital per worker and some education, and they should grow, right? Specifically, small countries or poor economies should grow faster than rich economies, right? Because of the decreasing returns on capital, the smaller ones should have higher growth rates. And for some countries, that's true. For instance, starting in the 1960s up through the fairly recent past, if you look at a lot of the current rich countries, they had pretty low incomes in the 60s. Korea, Singapore, Taiwan, they had low income and they grew really, really fast. Which countries grew the slowest? During that time, Switzerland, New Zealand, USA. Once an economy is already fully developed, it seems in the data that they're going to have slower growth rates. Now, despite the US's slower growth, the US was far enough ahead that a lot of countries still haven't caught up all the way. If you look at Western European countries, Canada and Japan, their real GDP per capita still hasn't caught up with the US GDP per capita. And why not? Well, part of the assumption is that it's because we have more flexible labor markets. There's less unions and less protections for our workers, which, that's something that we can argue about whether that's a good thing or a bad thing, but it does promote growth. More flexibility allows for more efficiency. And for countries with really big regulations and interventions, it's harder for them to maneuver to keep up. Another thing we could talk about is our financial system. It's a big deal. And there's a lot of protections for investors, which makes it easier and safer for them to work in financial markets, to get money to the companies who are ready to build and to produce and to innovate. That financial system is, in a lot of ways, more efficient than others. Now, for the poor countries, why aren't they getting growth? We talked about some countries catching up. We talked about the US already being rich. But what about ones who were poor and still are poor? There's no one answer for why they're like that, but there are a few common threads among them. One thing that can stifle growth is a failure to enforce the rule of law. If property rights are not protected, then there's no incentive for people to innovate and expand. Another is wars and revolutions. Countries with lots of destruction and lots of instability have a really hard time growing. Another is poor public education or public health. If people are sick and uneducated, they can't do as much to improve the overall state of your economy. And another one is if there's low savings rate and low investment. In a lot of these places, the banking system and the financial system is pretty weak, and it doesn't provide a lot of the protections or a lot of the benefits that we see in ours. And so these four things can really stifle growth. Now, with globalization, some of them get mitigated. For instance, the low savings and investment. If we have a globalized economy, foreign entities can bring investment into poor countries. And that's a thing, and it helps. We can get into whole debates about trade protection because those can limit that also. But foreign investment can bring technology, knowledge, and capital into poor countries that wouldn't be there otherwise. So in closing, if you want your economy to grow, I can name a few policies, or let's say policy areas, I won't get too specific, that will help your economy to grow. One, enhance your property rights and make sure that they're enforceable. Make it so that people have an incentive to innovate, whether that be through changing your court system or improving it or changing your patent system or something. Give them a reason to want to innovate. Another is to improve health and education. Getting them more educated and more healthy is good for the long-run health of your economy. Another are technologies that promote technological change. We talked about some of these earlier, like promoting research and development or promoting education, whatever it may be. If we can promote technology change, that helps too. And last, try to get people to save and invest. We have policies like 401ks and 403bs and IRAs, different things that incentivize people to save. And that savings enables investing. And that investing creates capital. And that capital helps to create growth. Did I get them all? Property rights, health and education, tech, saving. Yeah, I think that's it, guys. That should get you started. Check out my next video. I'll have one on the solo growth model. I don't know if I'll make others. We'll see. But thanks for watching, guys. Good luck and happy econing.